Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. We are back, episode 23 of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, I have a little rant this morning, if that's okay.
All right.
Can I take the mic for a second here, everybody? So I've got a little surgery on Friday. I've got a bunch of doctor appointments. I go to my doctor today 10 minutes early. I filled out everything on the website, on the app. I get there, they say, you were late. I'm like, what do you mean I'm late? They said you had to be here 25 minutes early to fill out this one piece of paper. They literally wouldn't see me. I'm like, I got a surgery. This is like a pre-op, meeting that has got to be done. What they call pre-op physical. Long story short, I didn't make too big a scene, but oh boy, I wanted to. I'm going to go to a different doctor later this afternoon. You got to be kidding me. The medical field. Crazy, man.
The wonders of the American healthcare system. That's all I'll say. I won't say anything more.
I want to just blow up the whole plate. Not blow it. I want to yell at everybody. And I was like, I can't do that. I have to have this surgery Friday. Like, I can't screw this up. So anyway, I'm a little flustered this morning, but it is what it is. How you doing, Sonu?
Good. You're not the only person that's hot. Looks like the economy is hot too, if you listen to some people.
Yeah, nice play there. I was going to use that segue as well. We're going to get right into it now. We are. I'm hot, and the economy's hot. We're calling this one, guys. Not too hot, not too cold, still not right. Kind of a fun take. We're going to spend most of the time at the beginning talking again about a lot of the economic data that we've been seeing come in really strong. What does that mean? Sonu's got some interesting takes on it. We're going to dive into that. We're, of course, going to take a look at March and April right around the corner. We had the February hangover. We talked about that a little bit. February can be weak, especially second half of the year. Good news, March and April are pretty strong seasonally, and we're going to talk about why we see, likely some strength in equities. Then we're going to finish things up with Warren Buffett's annual letter. It's always amazing. I've got a couple takes. Sonu's got a couple takes, and you always learn something from the Oracle of Omaha. So, Sonu, I'll set the stage for you. I wrote all these down. This is wild, man, and I'm going to turn it to you. Since Groundhog Day, which I want to, first off, did everything happen when the groundhog saw his shadow? Is that really why the economy got hot, Sonu?
Can we blame him? Or maybe he just saw what happened in January.
Yeah, I don't know.
Anyway, a warm January.
Yeah, since Groundhog Day is wild. You can't make it up. It's kind of like I said last year, the yield curve inverted on April Fool's Day. You can't make that up. This one, you can't make it up on Groundhog Day. 517,000 jobs versus 190,000. Since Groundhog Day, we've seen CPI come in at 6.4% versus 6.2%. PPI 0.7 versus 0.4. Core PCE inflation 4.7% versus 4.4. Pending home sales 8.2% versus 1%. Noticing a theme here, aren't you? New home sales 670,000 versus 620,000. Lastly, retail sales up 3% versus up 2%. There's more, but those are the headline ones that I scribbled down to myself the last 3 weeks. Sonu, why in the world has the economy gotten so hot since Groundhog Day?
Hot. I mean, to quote Bruno Mars and Mark Ronson, like, make a dragon want to retire here. But I don't know if it's an Uptown Funk reference for all of you who were into that song a few years ago.
That's a good song. I told you. I said he was my favorite halftime at the Super Bowl. We talked about that, I think, 2 weeks ago. I still say that. That was it. I love the Chili Peppers, though. So you bring out a little Uptown Funk and Chili Peppers. That was hot. But all right, so let's get to task, man. What's happening? What's going on out there?
Look, we had hot data in January, and part of it was seasonality, right? So this is data measured by the government, and we actually had soft data in December. Remember, Ryan, everyone was talking about recession in 2023 and all of that. Now that switched. So many people, I shouldn't say everyone, and we'll get to what we thought throughout, right? Most people have switched. They've been like, the economy is too hot. And too soft was too bad because obviously recessions are not good. Too hard is not good either because everyone's like, the Fed has to tighten even more, right? So you just swung the pendulum from one side to another. A big reason is, like I said, December was soft, and I think that gets to the way the government applies seasonality to their measurements, right? And the same thing happens, we've seen that for but 3 years running. Retail
Yeah.
sales, take retail sales, right? Retail sales up again. Another hot number that came in a couple of weeks ago, right? The January retail sales was up 3% or something massive like that. Well, December retail sales are really soft, and that's when everyone is getting really pessimistic. And then January rebounded. We've seen that for 3 years running now, right? So it's like the same story. It's like, come on, people, let's get some perspective. And you and I do this all the time. You look at
Hmm.
moving averages for a reason. You don't want to take
Yep.
one day's up or down and just run with it. Same thing with economic data. You don't take 1 month and just run with it. Take the last 3 months, right? And I think that's last 3 months is a good period. And you take consumption, largest part of the economy. Consumption's running about 2% over the last 3 months. That's 2% annualized, right? And so that's pretty much on trend, right? The economy would probably grow around 2%. That's literally trend growth that we saw over the last decade. It's not too hot, not too cold.
Yeah, great points there, Sonu. So here's the question then: if we were kind of hot-ish in January, I've heard there's some seasonal tweaks. Maybe you just talked about some of those, but also the better weather. No,
True.
one of the warmest Januaries on record. So not the question yet, but is that weather playing into it? And then what does it mean? Do we how do I want to take this? Steal forward, if you will, some strength from February. So do you think some of the data is going to come back in February and March? And was weather really the reason things were so strong in January?
Now, one thing with weather, I do want to point out, like weather effects are real, right? Because we
Yep.
had warm weather, people went out to restaurants more. That's real revenue, that's real profits, all of that, right? It's not seasonal adjustments, just to make it
Hmm.
clear, right? Seasonal adjustments, what the government, the folks measuring the stuff make after they get the actual data. But, better weather means more people actually, just take auto sales, right? We had 15.7 million auto sales in January. That's like an annualized pace, right? That was a big jump from where we were in December and November and October, right? And that was very
Yeah.
positive. That's one reason retail sales are as high as it did when it came in. That's probably going to fall back a little bit, probably going to fall
Mhm.
back to about 14 and a half million or so. I mean, which is, not great, but it's still like, again, look at the average, right? You take the average and you get to around 15 million. And that's better than what we saw over the last few months of 2022. But I think to get to what you were saying, there is a bit of that steal from the
Mhm.
future kind of impact here, right? It's like, oh, I have warm weather in January, so maybe I go out and buy a car right now, or warm weather in February. I know somebody who bought a car recently. We'll keep that aside,
Yep.
but yeah, no, more people spent because it's been nice outside, and I
Yeah.
think that's boosted the numbers.
Yeah, I love looking at kind of third party data, right? I mean, believe me, all look at government data, but just Open Table, they've got a lot of public data. They
Right.
saw a huge surge. Open Table, of course, is the app that you can use to make reservations at restaurants. Huge surge last month. I saw the CEO of Caesars Entertainment, so the casino company. Not a recommendation at all, but just his quote here: "I'm no economist, but I can tell you is what we see in our business is continued strength," right? And you think about every time you fly and you go out to restaurants, things are just packed, right? And it's that theme that we've had. And again, things maybe were a little bit better in January, but maybe a takeaway. And I do want to dive in just for a minute, though, Sono, on the data last week that really was kind of the big news. That was the core PCE or PCE. That's the Fed's favorite measure of inflation. That's at least what the media tell us. And I think, maybe it still is, but that did come in hot, right? Core came in hot.
Hmm.
The headline came in hot, similar to the what was it? The PPI a while back, similar to the CPI a while back. You've had time to look at the Fed's favorite measure of inflation, core PCE. What do you think it is telling us?
So PC is a personal consumption expenditures
Yep.
index, and that basically, instead of using like an inflation basket that's updated once in 2 years, actually now it's going to be updated once a year. It updates almost continuously, month after month, depending on what people spend on. If you spend more on restaurants, the next month, obviously, restaurants are weighted slightly more, right? I mean, you don't see massive changes. I don't mean to suggest that there are huge changes from month to month, but you get, it's more of an immediate representation of what consumers are actually buying and things like that, right? So that's why the Fed likes the PCE, and it's so that's the PCE price index, right? Now,
Yeah.
core excludes food and energy. right? We've talked about that before because those tend to be volatile. Now, inflation was running at, if you just take, let's say, CPI numbers, but PCE was just maybe 1 or 2% below that. It's running about 9% in June. It decelerated all the way to about, 6%, or, PCE is at 5.5, right, as of December. January came out at almost exactly the same number, 5.4% year over year, right? And core rose 0.6%. Over the past 3 months, core inflation's been running at about 4.7%. That's an annualized base. That's too high, right? Let's talk about why. Two big pieces of one. You and I have talked about this so many times. Shelter is a big part of that, right? Housing. And when we talk housing, we're not talking about home prices. Home prices and mortgage rates are not in the inflation index, right?
Yeah, I'll just
Either
jump in. I think I saw
CPI
Case Shiller just came out. I think it's 6 months in a
Yeah.
row now. Home prices have dropped according
Has
to
been
Case Shiller,
declining.
which just
Yes.
came out this morning.
Yeah.
Yeah.
So that, so the inflation baskets don't take that into account, right? Because, the home price, like, we don't sort of monetize that month after month. It's instead what the BLS does, what the government does, they assume we pay ourselves a rent. I know you and I own homes. They assume that you and I pay ourselves rent, right? Now, how do they get those rents? They look at market rents, right? Now, the way they look at market rents, there's a huge lag between what happens actually in the market and how the data is reported, right? So there's like 6 to 8 month lag. We're seeing market rents fall, like, Ryan, it's fallen over several months now, I think, right?
Oh,
if you just look
three
at
or four,
apartment
three or
lists.
four in a row. Yeah, if you look at apartment lists, Zillow's had similar historic drops. Now, it's historic on the upside. Let's be very clear, but historic on the way down too. Yeah,
right. So CPI, PCE yet to reflect that, right? So PCE has a smaller weight to housing, so which is part of the reason also I think Fed prefers that amongst a few other things. But then there's another big slice which makes up more than 50% of the basket, which, suddenly the Fed's talking about, they've been talking about the last couple of months, especially Powell at his press conference, which is core services excluding shelter, right?
Yeah.
Now, they tie that to wage growth, right? Think of these things as, airfares, restaurants, laundry, dry cleaning, childcare services, stuff like personal care, haircuts, things like that, right? The idea is, if I'm earning more, I'm going to go and spend that more of that on those kind of services, right? I'm going to take a better vacation, stuff like that. And so wage growth is closely tied to this core services, excluding housing. And that's running hot as well, right? That's running about 5%, over the past 3 months, just slightly above 5%. We yet to see a real slowdown there, which you've seen in headline inflation because energy prices have come down. But I think it's just a matter of time. Like, you and I have talked about the employment cost index and average hourly earnings. There's been good evidence that wage growth is decelerating, and that should feed into this core services ex housing number as well.
All right, so I'm going to jump in. Excellent.
I know that was a
stuff
lot
there. No, it was a lot there. I think it's an important concept because, again, the Fed is looking at this closely. You talk about hot. I don't know if you heard or not. My 140-pound dog, Walter, barked a little. We've got somebody must have came because he ran up the stairs. I text my wife middle. It's like, you got to get Walter. He's barking on the podcast. So Walter barked. He's saying hi. Anyway,
hello to him too.
Yeah, there you go. So let's get to the core. I'm trying. By the way, Walter, he gets groomed tomorrow. It's really expensive to groom a 140-pound Great Pyrenees. So I think I'm helping some of this inflation services stuff. By the way, with Walter, you think about. I mean, yes,
that's included in the number too. By the way, core services ex housing has pet care and all of that in there. So.
Well, we're doing it. We have to. Oh, he sheds terribly. Anyway, so core PCE services ex energy. That's another one the Fed watches closely, up 0.58% last month, the highest since November 21. I think the bottom line, the notes are owed to myself. Services is sticky, right? We're not seeing services come back as much yet. We've talked about it like a broken record, though. A lot of these things, specifically some of the used car prices and some of rents and housing and all that stuff, it's coming down. It just hasn't worked its way yet to the government's data, but it is what it is. When the market saw that number, it got a little dicey, but we're going to talk about next why the second half of February can be a little dicey. Sonu, we probably need to wrap this first part up. Anything else you want to talk about on the not too hot, not too cold, but still not, what do we call it? Not too hot, not too cold. I should know what we just called our podcast, but still not right theme here.
Still not right. Yeah. Yes. I was searching for that. No, the only thing I would mention goes back to weather and all of that. It's one thing to have warm weather, but you still we had summer or there's warm weather in 2008, but you didn't have people going and spending. Why? Because it was a recession, right? I mean, even 2009 June was like summer is bad. So it's not like You can have warm weather, but you need people to go out and spend. And they went out and spent. Why? Because incomes are high, right? Social Security increased. A lot of people got tax cuts. A lot of state, had imposed tax cuts in January. So that was a boost. And wage growth, right? Wage growth is still strong. If you think it's decelerating, but you had rising employment. People are working more hours, which means they had more income, more money in their pockets. They went out and spent. I think that's, you get to why is services inflation still hard? Well, that's because people are consuming services a lot more. Why are they consuming a lot more? Because incomes are higher. I think that's the story there.
Great point. You pointed out many times that real incomes have been increasing as inflation's pulling back lower as well. That's a big driver for the consumer. So let's move forward. We've talked before about the idea that January, wrong month, the February hangover. Historically, the best 3 months of the year for the S&P. November, December, January. Yes, this December wasn't very good, but the rally off the October lows, November, December were pretty solid. And then you have the hangover, which tends to be in February. I jokingly said I still remember the worst hangover I ever had. I was 40, had maybe one too many tequilas with some friends. My wife pointed out I'm old enough to make my own decisions. I blamed them. But let's just say it took me a few days to recover from that 40th birthday, and I haven't touched tequila since. I probably never will. So
speaking of a pull forward, you pull forward a decade of tequila.
Yeah. Oh my goodness.
Just joking.
More
there,
than enough. Oh, I don't know. It was a good amount. It seemed good at the time. That's how it works, right? Anyway, but hangovers take some time. You can eat, you can work out, you can sleep. You just sometimes need to just take some time, and they're going to go away. That's kind of like what happened. The second half of February historically is weak. We've seen ballpark, 4 or 5% correction on the S&P since the middle of February, really since Valentine's Day. Honestly, we peaked on Valentine's Day right around then. Into early March could be a little weak. But Sonu, here's the good news. March and April historically are two really strong months. In a pre-election year, they get even better. March is up about 2% on average. April up about 3.5% on average for the S&P in a pre-election year like we are. Also, a really interesting stat I saw on Twitter that high yield has actually been significantly outperforming the market as in the S&P over the past week. So high yield's been strengthening. We saw high yield really weak, over the past couple of weeks, and that was a warning sign maybe, but now high yield is strong. Why does that kind of matter? I think it does. I think it's a little clue. I put it this way, I'd rather see high yield strengthening than not if you're remotely bullish. Why does that matter?
I think that's such a good metric for several reasons, right? When you talk about high yield, what are we talking about? We're talking about companies who are not, A plus literally, or AAA or AA on the credit, spectrum, right? With respect to credit, mostly because borrowers don't think, are suspicious of them, right? Let's just put it that way, all right? And they think, you know what? I don't know if you can pay me back, what the money I'm loaning to you, right? The money you want to borrow from me. So I'm going to charge you a higher interest rate to cover my risk. So instead of, I may charge Apple 4.5% or 5%. I'm charging the federal government 4%. I'm going to charge Apple 5%. There's a little bit of premium there, right? But I'm going to charge you XYZ high yield company, let's call it that, 9%. Now 9% is actually attractive. Now, the thing is, when do these kind of companies, let's say default, right? They default if the economy is bad. If the economy is doing bad. So if high yield, is starting to do well, that means, instead of charging you 9%, I'm going to charge you 8%. That's what we mean when we say, oh, high yield is holding up, high yield is doing well, right? Because I trust these companies a little more to pay it back, right? And so that doing well is a good sign with respect to the company's ability to pay back what they borrowed. And that's a reflection of economic stability too. So I think that's a good sign from so many angles there.
Absolutely. Thanks to Frank Capillari. He's my buddy who pointed that out on Twitter. And I thought that was a great point that high yield last week, even though the stock market sold off ballpark 3%, high yield actually outperformed. So that was maybe some good sign. Also, Scott Brown, a guy I used to work with, Scott does awesome work. Scott Brown noted, we've been above the 200-day moving average for over a month now, Sonu. Okay, so I think it's like 25, 26 days above the 200-day moving average. If you look back in history, at least back to like the 1950s, when you have a bear market and then you're above the 200-day for a month or more, which officially we are, because in our world, a month is 21 days. That's trading days. So we've been above the 200-day for over a month now in the S&P after we're in a bear market. Scott took a look. In history, stocks have never gone on to make new lows. They've never rolled over. Now, full disclosure, last summer, we corrected more than 50% of the bear market. I noted at that time, market had never rolled over to make new lows, and you correct at least 50% of a bear market. It happened with the October lows, but then we rallied since. Nonetheless, I'd still say we can hang out above the 200-day like we are, like Scott's data shared, and the data I confirmed it. I looked at it myself. That's usually a pretty good sign. What's your take on that?
I think, that's sort of, I'm trying to think of a term for it. Duration of strength. Is that a good phrase for it? Duration of strength. That's always positive.
We should trademark that. I think so. I've never heard anyone say it, but I kind of like that. Yeah.
I was just thinking, duration of strength. That's always a good thing. The longer it is, the better. The longer something looks strong, the more likely it is to be strong.
Yeah.
Right. And applies to markets or any of us, really.
No, well said. I mean, I've done some studies on this, and I'm going by memory here, so these might not be exact numbers. But you look in history, some of the greatest one-day rallies ever, like 14 of the 15 greatest one-day rallies ever, took place beneath the 200-day moving average, the big majority of the worst days ever. So volatility happens. There's an old saying, I don't really know who said it, or I'd give him credit. Bad things happen under the 200-day moving average. Guys, we are still above the 200-day right now in the S&P. If we break it, believe me, maybe get a little more neutral, little more, slightly more cautious. We're hanging out there with some bullish seasonal time frames. Just some things to remember. Last comment, I'm noticing a lot of bears are starting to chirp a little bit more. You look at sentiment polls, we're starting to see a lot more bears. It took a 5% correction, and all of a sudden, everybody's bearish. Everybody was bullish 2 weeks ago. I'm not going to say who it was, but I saw someone on CNBC in the middle of February, a well-known bear. And she was talking about how markets rally and early in bull markets. I mean, she sounded bullish. And I'm like, oh, my goodness, this is probably a contrarian signal. Well, sure enough, markets pulled back since then. When you see a bear turn into a bull on TV live in front of your eyes. By the way, you're gonna see Cocaine Bear. Are you gonna see that movie Cocaine Bear? It made a ton of money. I think it looks amazing. What do you think?
Wow.
You gonna do that?
I don't know. You're the what do you call it? Gerard Butler type of,
Yeah.
I'm not quite there. I like the superhero movies and all that. But
I got you.
I'm watching Jack Ryan right now, so
Oh, that's good. Well, who's to say Cocaine Bear is not a hero? I saw him jump in that van in the previews. But anyway, we'll leave it at that. But that movie made a lot of money, so people are going out to the movies. Anyway,
speaking of bears, it's interesting. We had bears when the economic story was like, oh God, recession, and we had bears when the economic story, oh, it's too hot, right? Come on, get a grip. Right, everyone.
That's a great point. I mean, at least they're consistent. I guess we'll give them credit there. So, all right, the final we're going to move forward. We got a few minutes. The final conversation, Warren Buffett's annual letter came out, and it's awesome. We're going to dive into that. But first things first, I will admit, another little quick story. I did buy a car last Friday. I joined the club. Weather's nice. I said, I need a new car. I had a Volvo. If some of you listen to my past life and a past podcast, you know what I'm getting at. I hated that Volvo the second I bought it. I had so much trouble with that thing. I couldn't take it anymore. No offense to Volvo. No recommendations. None of this, none of that. Just personally, I didn't like the car. I had some issues with it. So got a Dodge Durango 5 or 6 days in. I love it. I will say last night I was driving my son back from basketball. Heard this huge thud. We were driving, man. We're going 35 miles an hour on a street here. And a big thud. And I was like, oh, my God, what you said in the car? It's like my son's back door. We turn around and look. I was like, let's look first. I didn't see like a bird or heaven forbid, like a dog or something. Then we get home. I didn't notice anything. I said, it would be something if I got a car for 4 days and have a claim already. But the car is awesome. I love my Dodge Durango. So goodbye, Volvo. And I'm one of the people that have used the good weather to go get a new car. I should have done it years ago, to be honest, looking back. But that's all right. Sonu, the annual Warren Buffett letter came out. It was amazing as always. I've got some thoughts. I know you had some thoughts on dividends and kind of, how he uses them, how he doesn't. That was fascinating. What else did you find from that letter that was eye-opening and worth sharing with our listeners?
I mean, what's interesting is the first page in the letter, or maybe after the contents and things like that, is literally he just lists all the returns.
Yep.
From 1965 to 2022, he doesn't hide it or anything like that. It's right in front. It's the first thing before he says even hello. Right.
Well, what's right in front. Real fast. Pete Rose says it ain't lying if you're telling the truth, right? So I think Pete Rose said that before. Yeah.
So, and you think the conviction that he's had to stick to. It's not easy being Buffett. It's not easy doing what he did. He'd say, like $1. Here it is, right? $1 invested in 1965 at Berkshire would have become $38,000. 38,000. That's like mind blowing. I mean, the compounded annual rate of growth is 19.8, 19.9%. That doesn't sound too high, but when you say $1 made it to $38,000, wow, right? But here's the thing, right? During those things, remember, sometimes you see those covers like, "Oh, is Buffett done? Buffett's over."
Oh yeah,
right? You had three. Like I was looking, 97 to 99, the S&P 500 rose 108%. Buffett was up 64%. I bet everyone would be. That's why you saw the Barron's covers. You saw the thing like, "Oh, that's the end of Buffett." 2018, 19, 20, the S&P was up 49%, right? Buffett was up 17%. I bet it would have been so easy. And maybe I would have done it too. I don't know. It's thrown in the towel. The guy, old man's done. Boom, he comes back, right? Well, last 2 years, S&P's up 5%. He's up 35%.
Wow.
I mean, talk about long-term consistency there.
That's amazing. So I'll jump in. I know you got some thoughts on dividends in a second, but I'll start the conversation with dividends. So, but what I thought was really cool, he pointed out the fact that he bought $1.3 billion worth of Coke in 94, $1.3 billion worth of American Express in 95. He kind of accumulated up to that point, but those are the totals. A very, very large buys for him, obviously, at that time. Just last year, Sonu, all right, the dividends from those two were over $1 billion combined. And he said all Charlie and him had to do was cash the checks, right? And it's eye-opening because now they're both like 5% of his portfolio, made a ton of money. Don't know the exact numbers, but made a ton of money on both. But just the dividends that are coming in. And what I loved, he pointed out, he said, I've made a ton of mistakes. A lot of investments did not work. A lot of things weren't great. But investors need to remember, you pick some solid companies, you give them time, and over time, a couple good ideas, whether it be luck or not, can really make up for a lot of sins. And he talks about that. The other thing that I love that he pointed out was that Charlie Munger did a podcast. I love Charlie. You talk about a guy who doesn't care anymore. He says whatever he wants to say. I'd love to get him on here and just have him say whatever he wants to say. But anyway, he said, the secret is finding out where you're going to die and just never going there.
Wow.
I thought that was funny. Warren pointed that out again. But, the idea of dividends and stock buybacks, that was a big discussion in the media. You've got a few thoughts on that. Maybe it's about the last thing we're going to talk about, then we're going to have to sign off. But talk to me about your take on what Uncle Warren had to say about those two things.
Yeah, look, I think I'm in the same camp as, which is not to put myself on any sort of pedestal that's close to Buffett, but, we aspire to these things. But look,
hey, we ate at the same. You know what? We ate at the same McDonald's as him last month. If you remember in our podcast, we looked for Warren, so we are sort of on the same. We're in the same. We're not the same pedestal. We're the same drive-through. Let's leave it at that. We're the same drive-through. I love that when it comes to McDonald's. Yeah.
Well put. So yeah, he talked about dividends and buybacks. So in his view, look, that's a way companies return money to shareholders, right? If you're returning dividends, that's a little more explicit. If you're buying back shares, there's less shares available to the public, which means the shares you own are worth more, right? It's just another way of returning money to shareholders. Now, the nuance was that he talked about companies doing buybacks, so that they should do buybacks when their stocks are undervalued. Hello, that's literally what he does, right? He said it's not like all buybacks are great. It's like, look for the smart CFOs, right? I mean, the ones who buy back shares when they're undervalued. And you think, if anyone should know whether a business is under or overvalued, it should be the company CFOs, right?
Sure.
So, but another part of his brilliance is, yes, he's done well with investing. And, the great part is he admits his mistakes as well. He said that. But the whole thing about dividends versus buybacks, you talk about Coca-Cola and American Express giving back dividends. Berkshire doesn't pay out a dividend, by the way.
Wait, let's stop that one more time. Let's stop that. Let's point this out, because I was shocked when you said that. As much as he bragged about making $1 billion last year on dividends, his company doesn't pay a dividend. Is that what you just said?
No. Yep. They don't pay a dividend. And there's a brilliant reason why. He just lets the money compound, because he always talks about compounding. That's how $1 became $38,000 after 58 years, right? Yeah. The thing is, if you pay out dividends, you have to pay taxes on those dividends year after year after year, right? And if you did that, and I didn't even assume, like, goodness, when I look back at history, the historical dividend tax rates, the highest rate is like 90%, right? Those like
Wow.
ridiculously high. So I was like, okay, I'm not going to take
Right.
90% away from the dividends when I'm trying to do this calculation. I was going to assume 50%, right? Which is too high. Right now, it's about 23.8%. That's the highest top rate, like if you pay tax on dividends. But remember, when you pay those taxes out, that money is not available to compound over, the next 30 years. So that $1, instead of becoming $38,000, that $1, if you pay taxes on dividends, if you paid out a dividend of like 3% year after year after year, that would become $21,000. Still great, but you see the difference there. It's a massive difference. That's why he doesn't pay dividends.
I mean, we could talk on this all day. It's just he's just amazing, right? I mean, he's the Oracle of Omaha for a reason. I mean, do you know of any other big? He's a conglomerate, but I kind of think of his company kind of like a financial in a way. I know they do other things, but do you know of any other companies that don't pay dividends like that? Like they all pay dividends. Does anyone else do that off the top of your head? I can't think of one. If you're a blue chip company, you pay a dividend. It's just what it is.
I mean, maybe only Amazon doesn't pay a dividend. I mean, amongst like the big, huge ones, but but they have other reasons for not doing that, right?
Sure.
So it's
anyway.
But Buffett's doing it because he's smart about taxes and compounding, right? It's like Berkshire is like an ETF almost. It's a collection of companies, and he would say collection of companies, not stocks.
Mm-hmm.
That's a difference there.
Yeah, it's paraphrase. Charlie and I, we buy companies, we don't buy stocks. Or no, we're company pickers, not stock pickers. I think I got that close enough. That's kind of what he said. But we've kind of hit the end of the road. This was a lot of fun. Hopefully everyone enjoyed the 23rd episode of Carson's Facts versus Feelings with Ryan and Sonu. Again, I do have a surgery coming this Friday, so I think I'll be on the podcast next Tuesday. And if I are, who knows? Maybe I'll be on some meds and I'll just say anything. I'll turn into Charlie Munger next Tuesday. You might have to rein me in, or Joey will have to edit it if I say something I shouldn't say. But we'll either Sony will be here or I'll be here next week. We'll see what happens. But we're going to keep doing it.
Good luck for that. We're rooting for you, buddy. So.
Well, yeah, I mean, I got to get my pre-op first. I got to go run around now and do a pre-op because the first place said I was late, even though I was 10 minutes early. But anyway, we'll leave it at that. But
for some reason, I don't think you're done with all the forms yet. But
I don't know what's going on anymore. I've got a box right in front of me, literally with medicine. I've got to take like 7 medicines tomorrow, 8 more the next day, and they spell it all out for you. It's kind of idiot proof, which I need. Believe me, it tells me when to do it and what to do. But there's a lot of medicine I got to take to get ready for this surgery. So anyway, I'll be good, but we'll see. But yeah, so we'll be back next week with the next Carson's Facts versus Feelings. Everyone, we appreciate it. This podcast continues to grow, and definitely listen to last week with Ed Clissold from Ned Davis Research. If you didn't get to listen to it, it was amazing. Ed's awesome. We're big fans of Ned Davis Research, obviously. And with all that, we'll see everybody next week. Have a great one. Take care. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.